Hello, my name is Tim Antonelli, and for those I have not yet met, I'm a portfolio manager and I'm the head of multi-asset strategy for insurers at Wellington Management. For this month's quick take, I wanted to focus on 20 recent recommendations made by the Federal Insurance Office to U.S. insurance regulators, focusing specifically on climate risk and oversight. Now, regardless of where an individual insurer may land on the issue of climate, I think it's critical to know how your supervisors are thinking about it. The implications here could be quite large as they've discussed adding additional risk based capital charges, increasing and making more robust scenario analysis, and including climate variables within statewide examinations. I'll note up front that these are purely recommendations, which means the NAIC does not need to make them into model law. It also means that individual states don't have to take them up as well. So let's talk through some of the implications that I found most interesting. Taking investments as the first example. The FIO pointed out that insurers should be aware of the impact of and the market expectations for changes in climate. Now, this means, in their view, embedding in the investment policy statement things like diversification requirements. They noted that you need to be doing this through every asset class, not just ones that are the most exposed. And they also suggest that the NAC should have additional staff that is specific to climate investing as part of the examination process. On the topic of risk management, the FAO noted that the NAIC should create a uniform climate scenario set that's done across the country. They should create specific additions to own risk and solvency assessments that look at climate variables. And they should define materiality thresholds for insurers for each peril. So that way insurers can focus on the ones that are most meaningful for their business. For regulatory supervision broadly, the recommendations began that states need to approach this in a much more uniform way. As we all know, every individual state's approach is quite different. They should ask insurers to keep and share more detailed information, particularly around geography with things like liabilities and assets, so they can look for potential bubbles of risk as it relates to climate. Regulators should also look to work with state legislatures and guarantee associations on climate risk specifically. And they should monitor the availability of reinsurance and question whether market hardening could impact insurers' solvencies in the future. Finally, they should conduct more disaster surveys after the fact around claims and coverage to make sure consumers aren't being hindered by an increase in frequency and severity of these events. Around the topic of risk-based capital, there was a specific ask for additional charges for things like floods, convective storms, and other perils that aren't covered within the US RBC system today. The report also highlighted some of the FAO's current priorities, including how disaster mitigation efforts by insurers can increase policyholder resilience, and also how they can continue to engage with best practices from global insurance regulators and supervisors to make sure the US doesn't fall too far behind. The last section of the report was focused on next steps. So the first was continuing an existing analysis on a deep dive about US insurer exposure to transition risk. They used year-end 2021 positioning data. And right now, they said 15% of corporate bonds and equities that they've studied are in scope for sectors that they deem to be most at risk for transition risk. They will be publishing a more detailed report soon, and rest assured, we will be sharing with you all in short order. They're also conducting a review of protection gaps, disaster mitigation, and resilience efforts, and would like to help build more programs based on consumer credits for taking these resilience and mitigation efforts on proactively. And in this case, they cited some specific analysis that said for every $1 spent before a disaster, they expected $11 in claims covers to be saved. And finally, they're going to continue to partner with international organizations like the International Association of Insurance Supervisors or the NGFS, the Network for the Greening of the Financial System. As noted earlier, these are simply recommendations at this point, and the ability for the FAO to implement these remains rather limited. However, I'd encourage U.S. insurers to keep tabs on these initiatives as they progress and keep an open line of communication with your regulator. I do think there are some steps you can take in the near term with regards to your invested assets, however. First, have an awareness of your overall climate exposure as the regulator or the FAO might see this. And this could look something like how the FAO is going about their transition risk analysis. In fact, regulators have often gone out to individuals insurers and had them use the PACTA tool to calculate transition risk. That could be a good first step. 2, consider how you would approach an inquiry from your regulator about the investment policy statement, including climate risk diversifications. What does that look like to you, and how could you evolve your portfolio to consider that moving forward? And finally, look for investments that could provide a secondary benefit outside of just a return profile. A great example of this are the investments that are under the California Coin Program umbrella, where if an investment is qualified, an insurer can invest above and beyond the state-based limit for Schedule BA assets. So you're essentially getting two benefits. As always, we will continue to monitor these events as they evolve, and we really appreciate you tuning in for us each month. Thanks.